The strength of the labour data in the US on Friday is still shifting expectations of when we'll see further interest rate cuts in the US. Stay tuned to find out more detail. The yield on US Treasury bonds was pushed higher on Monday following the surprisingly strong labour market data which we saw come through on Friday. The moves were pretty uniform across all maturities in the Treasury market, pushing up around 5 basis points. But for context, the yield on a 10-year Treasury bond is now above 4% for the first time since August, and that was the last time we saw labour market data surprise to the downside. So we're seeing quite a bit of volatility in terms of the labour market. There's a lot of focus on it at this point in time. Essentially what this is telling us is the market had priced in a lot of expectation that we were going to see interest rates come down further, and any data which presents a challenge to that, be it stronger economic data or more resilient inflation data, presents a challenge, and we're seeing sensitivity wash through the bond market. If we look at what the market is currently expecting, they were expecting to see another 0.5% reduction in interest rates at the November meeting. They've now dialed that back to 0.25, but in aggregate, still expecting two 0.25% interest rate cuts between now and the end of the year. And the long term is really what's important here. We're looking at day-to-day moves and the volatility which we're seeing, but in aggregate we're still expecting to see 1% worth of interest rate cuts come through in 2025, which will bring interest rates down to a level of around 3.5% by the end of next year. So that direction of travel, which is supportive of equity and bond markets, is still very much in place. We heard from a number of Federal Reserve speakers yesterday, but I'm going to pull out one which really matters here, and that's the New York Federal Reserve President, Williams. And Williams, again, left the door open to two 0.25% interest rate cuts to come through next year, but reiterated the importance of monitoring the data, which we're seeing very carefully here. We also had China and the Chinese stock market, which returned from the Golden Week holiday. Now, remember, China has been on a real tear since they unleashed what they proposed as a big injection into the economy from central banks at the end of last month. Now, we saw the market was a little bit cooler than was maybe initially expected, and this is because we had a press conference from the National Development and Reform Commission where the market was expecting to get a little bit more detail on what the government was going to do, so what the fiscal support would be to the market, and the detail was just lacking there. So just pausing in terms of the enthusiasm which the market has around China, but been on an incredible track record of performance there over the last number of weeks. So a couple of different dynamics to bring together there, some shorter term dynamics, but generally that longer term picture of inflation moderating, economic growth remaining fairly resilient, but at a level where central banks can afford to bring down interest rates is still very much in place. Thank you for watching. Stay tuned to find out more tomorrow here on Morning Markets.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.